What's going to happen with the market, I can't tell you, but I can tell you our country has gotten a lot stronger. And eventually, it'll be a country like no other. It'll be the most dominant country economically in the world.
President Trump defending his tariff barrage, offering no apologies for crashing the global markets. Live from Mumbai, this is Inside with me, Haslinda Amin, a show where we dive deeper into the big market moves with crucial context and sharp analysis. Investors run for cover as global equities get pummeled after China says it would rather let retaliatory tariffs do the talking. Beijing now floating further stimulus measures as stocks plunge and bond yields fall to a record low. Shell-shocked traders piling into U.S. Treasuries are pricing in a greater chance of the Fed aggressively cutting rates. However, Jerome Powell says he is in no hurry to react to the tariff-inflicted pain. We have a great lineup of guests to discuss China's policies to deal with tariffs and what that means for assets across the world. Well, it's a day of panic selling across Asia. Avril Hong is here to walk us through everything. Avril, is a sea of red. I mean, the HSI and the TAIEX down as much as 10%.
It's really startling to see these kind of losses, and you just talked about the magnitude of those declines. I mean, I'm going to go with Monday market mayhem, and I think investors were perhaps also holding out some hope that Trump would walk back his tariff approach over the weekend. Instead, he doubled down and likened it to taking medicine. So even for Chinese stocks, they're back from an extended weekend. They're forced to confront what seems like a reality of a new phase of a trade war between the U.S. and China. You talk about some of those declines earlier. The losses on the Hang Seng, the steepest since at least October of last year. We are 16% away from the recent peak. So approaching ever closer bear market territory. But just to give you a further sense of the panic selling, it's not just confined to equities. We're seeing it spread to other assets, including commodities. Brent plummeting after the Saudis cut prices. Goldman, for the second time in a week, cutting their targets on crude. And we're seeing some of that contango pricing featuring something that we saw in the early days of the pandemic. Even gold that has been surging because of safe haven demand earlier, slipping below $3,000. So it gives you a sense of the panic selling underway. The one thing that is doing well, we're seeing Treasury surging. The likes of TD actually expect 3% on the 10-year yield potentially before the year is through.
It is indeed carnage, and ugly doesn't even begin to describe it. What else are investors saying? We have not seen the worst, probably.
Yeah, I think they've been very critical, some of them, of this tariff approach, right? Some of them calling it a massive self-inflicted wound. We have hedge fund billionaires also not mincing their words, including the likes of Bill Ackman, calling it a mistake. And just to give you a sense of how this is figuring into some of the calls from Wall Street's biggest banks, flip the board, we have Goldman cutting their 3-month target for the broad-based Japanese gauge from 3,000 on the topics to 2,500. This chart, courtesy of MLive's Mark Cranfield, actually shows you the trading signals, the patterns, how similar it was to the yen carry trade unwind of August. But not just that, there are some that are now hearkening back to March 2020. At that time, the topics, remember, slumped about 30%, suggesting there is more to go on these declines in the Japanese gauge. We could see even below 2,000 levels on the topics.
Buy the dip only if you dare. Avril Hong, thank you so much for that. Now, President Trump is not backing down from tariffs or offering apologies for the market turmoil his tariffs have created. Speaking aboard Air Force One, he said no deal with China can happen unless the trade deficit problem is solved.
The trade trade deficit that we have with certain countries, way over $1 billion per country. But with China, it's $1 trillion. And we have to solve our trade deficit with China. We have $1 trillion trade deficit with China. Hundreds of billions of dollars a year we lose with China. And unless we solve that problem, I'm not going to make a deal. Now, I'm willing to deal with China, but they have to solve their surplus.
But Rubini Macro Associates CEO Nouriel Rubini thinks President Xi has the upper hand as he doesn't have to worry about political ramifications.
I think that Xi Jinping has more leverage. He doesn't face an election next year. He can use monetary policy, fiscal policy, and currency policy, and structural policy to strengthen domestic demand. And he's not going to give a Xi put a signal he's going to start to negotiate until Trump is really serious about de-escalating. But it looks like Trump doesn't want to de-escalate with China because he wants to corner China and to lead to a radical reduction of the trade imbalance between U.S. and China.
Well, let's get insights from our panel of guests. Zoe Liu is the Maurice R. Greenberg Senior Fellow for China Studies at the Council on Foreign Relations, and Polka Mishra is partner at Javelin Wealth Management. Polka, let's start with you. It does seem like this will go into the history books when you see the S&P being, drawn down by about 9%. And we're seeing losses of about 10% for the likes of the HSI. I mean, these are huge losses.
Yes, Haslinda, this is probably one of the hardest environments for investors and advisors to navigate. We work under certain assumptions around economics, as well as certain regulators and institutions working under certain mandates. And typically, those mandates are geared towards stability, bringing stability to global economy. Right now, we have one key institution that is insistent on deliberately destroying the global stability. So it's extremely difficult to navigate. And what markets and investors and businesses dislike more than bad news is uncertainty. And we're going to go through a period of uncertainty and an extended period of that at this moment.
But it's not just uncertainty, Polka. It is panic. I mean, we're seeing VIX, which we said was broken, is now at 50, when 2-3 weeks ago it was still hovering below 20.
Yes, it is. It is panic selling. We've seen panic selling. Of course, I mean, oil's drop. We have seen commodities fall, apart from just the global markets. And we saw gold dropping as well. That just shows that even the flight, what investors are trying to do is just book profits where they can and then potentially sit out. There's definitely a lot of panic. We've been talking to investors and trying to restructure the portfolios as best as we can, because the unknowns are so many and there are so many scenarios to factor in.
Zoe, let's bring you into this conversation. The panic is partly driven by the escalation in U.S.-China trade war. China has said it will resolutely respond. It's talked about 34% tariffs on imports from the U.S. Has this been a surprise on China's part?
Haslinda, thank you very much for having me. No, in fact, as of this morning, Beijing time, the People's Daily published 2 articles, one of which clearly pointed out that China has seen it coming. Not just that China has seen it coming, it has also spent years preparing for the potential escalatory trade war scenario. So from that perspective, this time China compared with the trade tension or trade war back in 2018, the Chinese government not only has established a more robust system to reduce their vulnerabilities, but has also diversified their trading relationship. So from that perspective, Beijing is very well prepared for this time.
But the question really is, how much room does it have to play hardball?
Haslinda, that is what Polka mentioned in terms of the uncertainties, right? But I do think that Beijing realized this time around it is not the only country being tariffed upon. In fact, Beijing pointed it out very clearly. It does not matter what kind of war that Washington, D.C. or the Trump administration wants, whether it is a tariff war or any other type of war, Beijing is going to retaliate and respond. And on top of that, Beijing has also been implementing a series of domestic policies trying to boost household consumption, trying to diversify its trading partner, not just with its regional partners like Korea and Japan, but also has been accelerating a series of free trade agreements over the past few years. So from that perspective, Beijing has flexibility, but the challenge for Beijing is whether its bet on investing massively on science and technological development, whether it has enough time to cushion out the existing structural walls, while the scientific technological benefit can also have the added benefit of improving total factor productivity.
And Polka, of course, we know that China is back from a long holiday. We're seeing losses. We're seeing the HSI pretty much driven by China-related stocks slumping almost 10%. You do get a sense that investors perhaps underestimated how China would respond.
I think that's right, Haslinda, because so far, despite all the noise from the United States, we have not heard much from China. They've continued to say that we will retaliate, but we did not see action. We did not see currency weakening. We did not see retaliatory tariffs. So this one has definitely shocked the investor community and probably even the United States. And that's why we are seeing an extended losses in the market. But one still has to believe that a lot of this has to do with posturing, anchoring, and these are a lot of negotiation tactics to not go to the table with a weak standing.
Well, lots of murmurs about China possibly devaluing the yuan as a tool to get the U.S. back into negotiating mode. Do you see that happening?
I think that is a very strong tool China has. We have been hearing numbers between 3 to 15% of devaluation of yuan. It depends on how retaliatory China wants to be. From our perspective, I think ironically China can come out strong from this and possibly, and we've heard narrative from Beijing around talking about stability and talking about projecting itself as a potential stable trade partner at a point where friends and foe are both losing confidence in the United States. So the bigger concern that China needs to address if it has to benefit from this scenario, it's not about just weakening the currency. It's not just about the war with or trade war with the United States, but for China to build further on the relationships that it's building and the investment it's been putting with the rest of the world to become a stable trading partner. What that means is that the stimulus that we are talking about, the big bazooka that we've been expecting, right now is the time, because the biggest concern trading partners have with China is the overcapacity. So if China can stimulate domestic demand and increase consumption, then it balances out trade for those trading partners and could come out smiling from all of this. I'm obviously exaggerating a bit.
Zoe, what do you think? Can China afford to devalue its currency? Bearing in mind what happened in 2015 when it devalued the yuan, we saw how China assets got hammered.
And Haslinda, that is exactly the right time frame I would think about it in terms of 2015. But I think I might be a contrarian, and I do not think, and this time around, I actually do not think the Chinese government is going to be willingly devaluate the renminbi for two reasons. The first reason is that if we just look at the numbers, renminbi to US dollar exchange rate right at this moment is on par around the 2018 level after the devaluation. And then on top of that, the second reason is more about the political economy, in the sense that on the one hand, President Xi Jinping has been emphasizing building China as a financial power. And he also talked about strengthening the renminbi as a strong currency. Strong not necessarily in terms of making the renminbi overvalued, but in terms of making the renminbi an anchoring currency for the Chinese import-export, overseas investment, what have you. So from that perspective, devaluating the renminbi is not going to be conducive to achieve President Xi Jinping's goal to make China as a great financial powerhouse. So for those two reasons, I do not think the Chinese government is going to willingly devaluate the renminbi.
The bigger concern is not just domestic but international. It has, I guess, huge implications on the global markets.
Exactly. And here, the implications for global market, I would say, comes from probably three folds. The first one is China compared yes, the Chinese economy seems to be on a more stable footing compared with last year, but that does not necessarily mean the Chinese government has successfully addressed all its structural woes. In fact, it's a lot of the policy uncertainties that the Trump administration has implemented that makes the Chinese market actually relatively better. So I think investment opportunities are really in terms of relativity, right? And then secondly, if global economies or global CEOs, when they look around where to invest, they do not make investment decisions based upon who is in the White House today. They make investment based upon long-term horizon. So from that perspective, if we look at the next 4 years, it seems that the Chinese domestic political environment perhaps is more stable than the US. And the last part is in terms of to what extent the Chinese government has been successfully building a renminbi-based alternative financial system that can shelter China, can reduce China's vulnerability to Western sanctions. And from that perspective, this is actually a good opportunity for China to basically expand the renminbi-based financial infrastructure.
Right, and Polka, to Zoe's point, if you take a look at a longer-term perspective, perhaps in the next 4 to 5 years, the fundamentals in China and perhaps even Europe look better than the U.S. Would you agree, and would you be preparing to invest in those markets?
That's absolutely right, and I completely agree with Zoe. I would like to highlight that what Zoe mentioned, that investors don't want to look at who's don't want to make the decisions based on who's in the White House. And unfortunately, with the United States, the policy continuity is not happening. It's changing so much with the government that's coming in. So investors are looking for alternatives. We have actually preemptively, before the tariffs, we did readjust the portfolios, just exactly as you mentioned, Haslinda. We have reduced our allocation to U.S. We've lightened up on U.S. technology. We have added to China. We do hold Europe. Of course, we have added to safe assets as well. Gold continues to play an important role. But I think, yes, what we're looking at, probably not the end of U.S. exceptionalism, but a bit of re-globalization, and investors are looking at other alternatives, and they are available.
And Polka, what's interesting is that we've been talking about how traders, investors are, I guess, gravitating towards safe haven, safe assets, and that traditionally includes the U.S. dollar. But here we are with a U.S. dollar that's actually weakening. How are you reading into that?
So that is one of the first signs that the U.S. exceptionalism is being questioned, because typically you would see a flight to safety to U.S. dollar, but we saw U.S. dollar weaken significantly, and investors went into Swiss franc and the yen. And I think that is, and it's being done by the United States. So you're absolutely right. We do need to find other assets, and that's probably in the long run it is going to get. It's a diversification that started post the GFC, and it is continuing. It happened during the first Trump administration as well. So we will have more diversified portfolios. I mean, U.S. still remains important. It's 65% of the global equities index. But remember, Japan was more than 40% at one point of time. So things can change, and they have started to change.
And as we speak, we have the HS Tech Index currently slumping about 13%. Of course, bearing in mind that HS Tech led the rally earlier this year. Now we're seeing China, Hong Kong playing catch up after that holiday for China. HS Tech currently down about 13%. Zoe, to the point of a USD that is weakening, that can only help the likes of the yuan and the policy that the PBOC adopts for the currency.
In a lot of ways, volatilities in the dollars market is going to make the PBOC or especially China's holding of foreign exchange reserves suffer, because China's over $3 trillion of foreign exchange reserves are heavily exposed to the dollar-denominated asset. So from that perspective, a weakening of dollar from a pure economic and monetary perspective is going to make the People's Bank of China suffer. However, I think this time around, the PBOC is prepared in terms of practicing what it called as structural monetary tools, which is trying to use different varieties of interest rate tools to boost domestic consumption, boost small and medium-sized enterprises, and trying to use Chinese policy banks, especially China Development Bank, to provide all sorts of financial support to China's domestic market. And on top of that, just I think last week, the Chinese government also boosted the capital ratio of 6 major Chinese state-owned banks. So in a lot of ways, although the dollar's weakening is going to make the PBOC suffer a lot, they have been preparing for this, and they have quite a degree of flexibility as well as tools to respond.
Zoe, thank you so much for that. Zoe Liu from the Council on Foreign Relations, and of course, Polka Mishra of Javelin Wealth Management. We have some breaking news out of Australia. Jim Chalmers, the Australian Treasurer, says that Australian GDP will take a hit from those tariffs. Of course, he's not the first one to be saying that. We've heard from quite a number of officials from across the globe suggesting that GDP will take a hit. Singapore, for instance, did say that it will take a hit, but it refrained from saying by how much. Jim Chalmers speaking in Sydney, and we're also hearing from Ishiba in Japan saying that there must be clear that Japan employs many people in the U.S. who will seek tariff exemption to create U.S. jobs, and that it must achieve wage rises in tandem with inflation. So lots of lines suggesting that perhaps countries are trying to address the concerns brought up by Trump in this environment where tariffs are going higher. And of course, we've had that universal 10% tariffs across the board, pretty much. Well, still ahead this hour, Kotak Alternate Asset Managers joins us with their outlook for Indian markets after the Modi government indicates a desire for trade talks with the U.S. Keep it here with us. This is Bloomberg.
If we get a recession, we don't think there's going to be V-shaped recovery, because the source of recession is politics, war, and tariff. This is all lasting for more than like a year. So this is probably going to be like W-shape or U-shape if we ever recover.
Korea has been one of the biggest foreign investors in the U.S., semiconductor, EV, batteries, and right now this shipbuilding, the defense industrial sector, I think Korean companies can play a role in sort of collaborating with the U.S. and help the U.S. to achieve, that policy goal.
I think it's really about Trump watching the market and thinking, gosh, if everybody's wealth effect is going deeply negative, if corporates are not going to hire people, if people are not going to go out and consume, and everybody's just in complete and total, disarray and shock. Actually, I think the worse, the better, as in like bad is good. If the market keeps crashing this way for another 3 or 4 days, he's going to have to come out and do something or say something.
Some of our guests reacting to Trump's trade war and the market meltdown that's deepening this Monday. Let's take a look at how Indian bonds and the rupee are trading. 10-year yield dipping below that 6.5% level. That's the lowest in more than 2 years. We saw some recovery in the Indian rupee, but not enough for a reversal in sentiment when it comes to the currency. Of course, India starts trading momentarily. We'll bring you the very latest as the market opens. In the meantime, India's government has indicated it won't take retaliatory action against the U.S. for imposing reciprocal tariffs, focusing its efforts instead on negotiating a bilateral trade deal with the Trump administration. Joining us now is the Investment and Strategy CEO at Kotak Alternate Asset Managers, Lakshmi Iyer. Lakshmi, good to have you with us. Before we get to India, we have to talk about the general market sentiment. It's about Liberation Day, the tariffs, and some say perhaps it will go down in history to the equivalent of perhaps the dot-com bubble bursting, the Great Depression, and so on and so forth.
Of course.
What do you think?
So firstly, I say that, I'm reminding, the song which says it's another manic Monday, and I wish it were a Sunday. I literally wish as a money manager it were a Sunday, because the narrative and the sound vibes that are kind of getting hammered into the ears is so significantly high across the globe. It has actually pushed the fear gauge index globally into another level, and that's clearly suggesting a lot of panic. Are we in a similar scenario compared to what we saw, in all these periods, including the Great Depression? Well, the answer is no. It is a shock treatment. And when you get a shock treatment, whether it's to the body or whether it's to the financial body, it obviously takes time to absorb, and probably, one needs to ease off at this moment, breathe a lot. I did my meditation, by the way. And then look at things from a slightly more non-jaundiced lens. I think that is the need of the hour.
So is Trump right? Is Trump right in saying, don't worry, it'll be fine? There'll be some normalization at some point.
So, well, it's Trump, tariff, trauma on the portfolio, and the fourth T is what we need to do as investors, which is learning to thrive. Will it be that you can see some possibilities of the tariffs getting pushed? Well, this is all conjecture. This is all like a toss of a coin. So what we can control, obviously, in this market, Haslinda, is our emotions, which is greed and fear.
But the thing is, we're seeing massive, massive moves in the markets. I mean, HSI alone, yes, of course, is playing catch-up because of the holidays, but it's down more than 10% in a day. Yeah. A draw down from the S&P, a weekly of a 9%. I mean, we don't see these movements.
Not at all. In fact, I was just, before this, I was on a call with one of the large investors who's actually asked me that, does this remind you of the 1987 crash? And, where the Dow, dropped over 20% in a day. And the point is that anything is possible, because this is like a huge interconnected global market. And never say never. So I think we need to brace for more volatility as an investor. We need to keep our dry powder handy. We have to find a method in the madness. Manic it is. But if we lose our cool, as I said, the portfolios will not be able to fructify its full objective.
Too soon to be looking at opportunities, right? Because, I mean, some murmurs out there saying that, the retail investors are going to find opportunities. They will be the ones to prop it up.
So if you look at the US data, retail investors did pump in close to about $5 billion in the fall on Friday. Well, I would say reverse. I would say keep your shopping bag ready. So, you need to put the things in your cart, whether it's stocks or it's funds or it's bonds, put it in your shopping cart and be there to click the trigger button, which is the buy. I would say, and would you be able to, as an investor, catch the best timing in the market? I would say two types of people, liar and lucky people. I am neither. So I would rather be ready with my shopping cart and cherry pick opportunities in this market.
But what signs are you looking for? And what are you looking at? Are you looking at treasury yields when they drop to a certain level? I mean, what are the signs you're looking for before you start dipping your toes?
So I'd say two things. Today, given the way things are happening, the global economy is suggesting, or the market moves, including treasuries, gold, everything is indicating a potential stagflation kind of a scenario. And in that kind of market, you can't do a carte blanche investment approach and tic-tac-toe and assume that everything that you pick and choose is going to go up. So I'd say in this kind of market, the key triggers would be obviously the man who started it all. What is he going to say? and more importantly, how the countries are going to behave. I think these are the two triggers.
You know, as we speak, we're seeing a further sell-off in Asia, and now the MSCI Asia-Pac index is actually down by more than 7% right now. It is set for its worst since 2008. So, you know, it continues to reel when it comes to the equity markets in particular. I'm just wondering, where do you go from here? I mean, if you're waiting for the bottom, what do you do in the meantime? Just sit on your hands and sit on your dry powder?
That's absolutely very, very valid. And I think that is pretty much the question on every investor's mind today. Two ways to look at it, and that's the way we would probably deploy monies in this kind of a market. One is don't rush, saying that, you know, because bottom fishing is a skill and it's very, very difficult to do skill-based investing in this market. So that's point number one. I think the next best approach would be that if you are fundamentally convinced, whether it's the US markets, whether it's India markets, that overall if valuations are good and you don't mind at buying at a particular price, which is the GARP, buy at a reasonable price or growth at a reasonable price, then I'd say staggering your investments on every fall would be a very prudent strategy even in this market. Sounds very cliched and old-fashioned, but Haslinda, it's worked very well for investors, and I'd see no reason that this time on also it will not work.
So across asset classes and across geographies, is that what you're saying?
So specifically, I would say for India, given that valuations are getting more tolerable and I would say breathable from suffocation region, so that's definitely number one. And I would say that that would apply even for geographies like the US, like China, for example. Gold has corrected from peaks, but is it correction really, given the fact that the rally has been absolutely stupendous? I'd say gold probably has more elbow room to fall down, and that is when you could add on. So instead of doing, staggered investment works well in equities across geographies, but when it's gold as an asset class, I'd say just hold on to a little bit, let it ease off, let it cool off, and then you can make your investments.
Even as we keep one eye on the markets, we're also keeping another eye on policymakers like the Fed. Now some say that you can expect more rate cuts from Fed and it'll come earlier than anticipated. I mean, that seems like a logical conclusion.
Seems very logical, though. Even now, if you look at markets, it's talking about 2 rate cuts in the entire year. But look at some of the other markets. So at least the yield curve is actually pricing in many more rate cuts because the big, I would say, hero in the pack, I would say, is crude oil prices. And countries like ours, who are price takers, are finding a great solace in that, which is why you see it's great time for, say, OMCs, oil marketing companies. So I'd say that crude being where it is, inflation not being really a big concern, I think opens up more elbow room for policymakers to cut rates more meaningfully. And I think here proactivity would be definitely the buzzword than being reactive.
And of course, the RBI set to cut rates today. That's a gimme. The question really is where it goes from here. I mean, if you take a look at the rupee, for instance, it puts the RBI between a rock and a hard place.
Totally, totally. The good news is that if you look at the dollar rupee, it's behaved itself reasonably well in this entire chaos. The dollar index is down over 6.5–7%. The rupee is fairly well behaved. And of course, the RBI is there to ensure that there is an orderly movement in the rupee. I think all that augurs well. Even when the rupee was not on a great innings, we actually saw the central banker cut rates. So we definitely believe that this week we will see RBI relenting with another rate cut.
And as we speak, the Nifty index is down about 5%, joining in that, the sell-off that we're seeing right now. You can only imagine that even the RBI governor will be looking at the market sell-off, bearing in mind that this is a market driven by retail investors.
Absolutely. We have almost $3 billion of annuity, which is month-on-month money, which retail investors actually pump into the equity markets. It's a very, very strong rock effect, I would say, to ensure that if, in a case, foreign investors actually turn hostile and they pump out money. Very unlikely, I would say, and I'll tell you the reason why. Because emerging markets will catch the investors' attention. at a much broader brush, including India, given the fact that, and I'm sure we've all seen the trade sensitivities, we are among the lesser impacted nations. So I would say that psychological effect, yes, we cannot wish it away, but I think that's the time when you have to go shopping with your cart ready.
So is this the time when foreign investors will buy into the industry? You talk about how it is less impacted. By that, you mean 26% tariffs versus the likes of China at 34, Vietnam at 46.
Yeah.
So is that that's what's going to drive international investors back to the Indian market?
That, and as I said, even if you look at a knock on the GDP, well, it's very early days, but the number would be anything lower end of 25, 50 basis points to upwards of a percentage point. Even if we consider that knock off, India still seems to be the fastest growing nation in the world with a relatively docile inflation. So I think if I pair that two together, it clearly tells you that money which is seeking global allocation should definitely find, and as I said earlier, Haslinda, the valuations are now in breathable territory. So of course there is more
breathable but not cheap, despite the sell-off that we saw recently.
That's right, that's right. Which country in the world is cheap today? I'd say among the formidable countries, it's China, definitely. So that's a country that we also like as an allocator, but more of a tactical play. But certainly from a long-term allocation perspective, as India gets into more cheaper realms, look at mid-cap index. It's corrected 11%, whereas the frontline Nifty is just about 3%. I'm talking about before today's fall. So I'd say that those opportunities will definitely unravel. And I would say investors will look forward to India facing inward consumption-based opportunities rather than looking at external opportunities.
It is a perennial question, India versus China. You talked about fundamentals. If you take a longer-term perspective, 4 to 5 years from now, people say that it is China that is more attractive than India.
I wouldn't completely disagree with that, but I'd say that the growth prospects, the transparency, the reformist mindset, and the one for all kind of an attitude and approach with the policymakers and the politics have, I'd say India will still continue to play a dominant role even after the rally that we've seen in China. China on a market basis still looks cheap. But of course, it's got all its bells and whistles which keep coming, surfacing from time to time. So I'd say definitely China makes a case for ownership. I'm not denying that. But it's not India versus China. There is a case for coexistence.
Some say that one of the risks for India is the subprime crisis, not the likes of the US, where it's about mortgages. This is about microfinance. Are you as concerned about the subprime crisis in the country?
So, we need to dissect the situation and find out, are they well capitalized today compared to what they were in 2008 or probably in 2020? The answer is yes. They've raised enough capital. Is the, unsecured market having a little bit of issues? But is it so big enough to really kind of jeopardize the entire global landscape or the India story per se? The answer is no. Because it's still a small peck in the ocean, whether you look at the bank balance sheet or you look at, specific microfinance companies which are doing this lending. But they do have dry powder. So I don't think it's fair to compare it to a subprime crisis. One needs to be watchful of the unsecured and try to probably pare down some positions. But losing your sleep over it, I don't think so.
For those who have cut the exposure to India, what would you say to them?
I'd say that, and I said this earlier, and I'm going to reiterate the same thing, that it's very difficult to do bottom fishing in this market. And I've tested this over 2.5 decades. And I realized that trying to probably look at valuations and make that investments, and of course, look at the momentum factors, definitely make a lot of sense. But staying away for a long time, waiting for that absolute best, I think would be very difficult. I must hasten also to add that putting everything today just because there is a fall also is not the right strategy. The truth lies somewhere midway. I think that's the way we need to progress in this market. So staggered approach is the way I would recommend.
Lakshmi, hang on tight. Speaking of India, Avril is back for a look at how the Indian markets are looking at the open. Avril, take us through the early numbers.
Yeah, I mean, we're already seeing how India futures are declining upwards of 5%, so we can expect a really bad decline when it comes to the open. And we're also getting this foreshadowing, right? You think about how the region's benchmark is slumping by the most since at least the GFC. Some of the gauges in the region, including the Singapore, Taiwan stock benchmarks, slumping by the most on record. And I think traders are at this point really trying to grasp for references. Is this worse than the pandemic, worse than GFC, AFC, dot-com bubble? Where are we taking our references from? And this is the open, this is the picture, 5% almost down on the Sensex, Nifty. Banks are also getting hit. And amid all this, don't forget that the losses in India were pretty mild last week, so there's plenty of room for catch down. Really interesting how on a day like this, some of the Asia's central banks are conspicuously not coming out with their usual reassurances. Think as well that this week we have an RBI decision due. Yet more reason, I think, for some support for markets, maybe making the case for a cut. Has.
Avril, thank you so much for that. Lakshmi, I've got alternate asset management still with us. So a 4% drop, pretty muted when compared to the rest of the region, the rest of Asia. We're seeing 9% for TAIEX, and we're seeing Singapore down about 8%. I mean, what's your response? Are we expected to see the losses get deeper further down the road?
I don't rule out these cuts getting a little bit deeper. I don't deny that, because there could be some margin traders, for example. They may have to square off their position. So you could see some bit of that happening. But, you know, I definitely say this one thing to you. You know, if India is, you know, likened to an oasis in the desert does have sandstorms. So how can you completely be insulated? It's not going to be possible. So I think that's what we are getting to see today. And hold in tight and belt yourself. I think that is so going to be critical.
That's right. Brace, brace. Lakshmi, thank you so much. Lakshmi Iyer, CEO, Investment and Strategy at Kotak Alternate Asset Managers. Well, still to come, we focus on oil's tumble amid Trump's tariff war and a big price cut out of Saudi Arabia. We're live to Dubai next. Keep it here with us. This is Bloomberg. Well, flight from global equities has accelerated here in Asia, with investors piling into haven assets as the fallout from Trump's tariffs deepens. For more, let's bring in Bloomberg MLive strategist Mark Cranfield. Mark, when you take a look at VIX now expanding to about 51, I don't believe I've seen the VIX at such levels. And when you see the HSI slumping about 11% in one day, you know it is not an ordinary day.
Yeah, pretty ugly. A true Black Monday developing here in Asia, especially. One of the major issues here for investors is there's a lot of comparisons being made with March 2020 when the pandemic started and markets absolutely cratered around the world. And at that time, it was pretty much a no-brainer. Every investor expected that central banks would come in at some stage, come in with big support. And that's exactly what happened. Federal Reserve, European Central Bank, everybody was cutting interest rates aggressively, bigger amounts than usual, getting rates down to zero in some cases. So the level of stimulus was very quick, and we saw rapid rebounds in major equity markets around the world. What's complicating the picture this time around is we just heard from Jerome Powell just on Friday last week saying that this time around, he's concerned that all these tariffs could put inflationary pressures, upward inflationary pressures in the United States, and we have a CPI number coming out this week. He does not sound like a man who's going to give investors a bailout this week. He doesn't sound like he wants to cut interest rates in a hurry, and that's not good news for traders around the world. And then if you look at the way that obviously some countries have already said they will put on tariffs against the United States, that's also complicating the picture. So this is not exactly like the playbook from 2020, and it doesn't sound like the big central banks can help out as much as they could back then.
And obviously, markets, traders are overwhelmed. Where do we go from here? We know that those losses are deepening from here.
Part of what's happening in the past two sessions especially is margin calls. The big leverage traders in the markets have racked up very large positions. The markets are moving very quickly. Their banks are asking for much more collateral. That's forcing them to sell more positions. That process probably will come to an end today or tomorrow, at least the main stage of it. So we might see a bit of stability start by the middle of the week. We also would expect markets to rebound a bit as soon as we get some sign of positive headlines that this country or that country has got some concession out of the United States. There's a lot of chances of whiplash trading this week, markets unexpectedly reversing course.
Right.
And we would expect that some money would come in, some dip buyers would start to come in. It's going to be very erratic. But the big picture is the trade war has started, and that's not good news.
Mark, we have to leave it there. Mark Cranfield, Bloomberg AmLive strategist. Now let's look ahead and bring in a Horizons Middle East and Africa anchor, Jumana Basachi in Dubai. And Jumana, big losses in oil today on tariffs, along with the biggest Saudi price cut in more than 2 years.
Yeah, well, it looks as though Middle East markets are certainly not immune to the global rout that's taking place. Remember that Middle East markets usually trade on a Sunday. So yesterday we saw a bit of a reaction to the massive tumble we saw in global markets on Friday. Yesterday, the Tadawul index in Saudi dropping 6%. Other markets around the Middle East also dropping a similar amount. Tel Aviv Stock Exchange dropping the most since the October 7 attacks. So yes, they're definitely feeling the ramifications. And what is happening in this part of the world is it's a double whammy. You have the surprise initiation of those 10% tariff rates. Nobody from the region was expecting any tariff rates to be applied to the countries from this part of the world, especially because many of them actually run a trade deficit with the U.S. So that was the first surprise. But then the second surprise came towards the end of the week with that OPEC Plus announcement to accelerate the timing of bringing forward those extra production barrels to the market. And on the back of that, you saw a big collapse in the price of oil. It's down 15% in the last 3 sessions. And given how many GCC nations are still so heavily hydrocarbon dependent, this has knock-on effects for many of the stocks in the region, and also investors asking about what this is going to mean for many of these countries' budget deficits in the years to come. So yes, double whammy, and you certainly are seeing volatility creep into some of these Middle East markets too.
Jumana, thank you so much for that. Horizons Middle East and Africa anchor, Jumana Basachi there. Now, before we go, here's a look at our guests for tomorrow. The CEO of the National Stock Exchange of India will be joining us exclusively at the India Global Forum here in Mumbai. Plus, we'll have more market analysis with Maybank Group Wealth Management CIO Eddie Lowe. In the meantime, let's do a check on where we are in terms of those massive market moves. HSI extending its loss to almost 11%. Right now, we have the likes of the TAIEX down more than 10%. Singapore's STI not spared either. This market, small it may be, but lower by about 8%. That is it for Insight from here in Mumbai. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.